And there's so many economies of scale that can come from owning a large number of assets in the same area in terms of saving on expenses and costs and managing things more efficiently and having your team really dialed in there. And so I think there's a lot of benefit that can offset, that risk of saying, okay, well, what if something specific happens in that area?
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. As you scale and grow your real estate portfolio, the ability to manage the growth becomes very, very important. If you go too slow, you can stagnate. And if you go too fast, you could outpace your team's ability to keep up. Well, today's guest understands this very, very well. She's a former Wall Street portfolio manager managing a $2 billion portfolio. Now, she took this experience and became a full-time real estate investor. To that end, she founded a group that syndicates apartment complexes and has over $61 million in assets under management. Now, today, as the founder and CFO of Akras Capital, she focuses on deal underwriting and asset management of their portfolio. Additionally, her and her company, they built financial freedom for numerous clients throughout the United States. Now, with all that, I'd like to welcome Kristina Knight to the show. Hey, Kristina, thanks for coming on.
Hi, Augustino. Thanks for having me.
Yeah, it's going to be awesome.
Yeah, super excited to be here.
Yeah, thanks. Now, if you like what Kristina has to say, you can reach her via her contact page at akrascapital.com. And if you like our content, please don't forget to leave a comment and rate the show. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Kristina, go ahead and tell listeners a little bit more about how you got your start in finance and maybe what you were doing before the real estate game that you're in now.
Yeah. So, before I got into real estate, I spent over a decade in the investment management industry. Started off as an analyst and then graduated from that to a senior analyst and then trader and then portfolio manager. So I've kind of seen the breadth of that industry. It was largely in fixed income, not the equity space. So I was working with bonds and different types of investments in that realm. And then my first job out of college, I was an analyst for a HELOC portfolio. So, that was right during the 07-08 crisis. I was tasked with monitoring this HELOC portfolio and watching delinquencies go through the roof. And that was kind of the start of my career. Then I became a mortgage analyst and I became, the main point person for the bank on the housing sector. And so I built this career even before real estate focused on mortgages, housing, finance, and really understanding the housing market and how that related to investments. And then, from that experience, then I spent multiple years as a PM and was our main mortgage portfolio manager, managing all the investments and mortgages that went into a number of portfolios for institutional clients, foundations, nonprofits, you name it, and then working with those clients to help build those portfolios. So, I was managing portfolios from $10 million to $50 million in an overall strategy that wound up being a little over $2 billion.
Nice. So at what point did you decide that, after doing all that stuff, that you really had to go and do your own thing? So it sounds like you saw opportunity there, but at what point did you say, you know what, I'm just going to go ahead and try this myself?
Yeah. So, working in finance and investment management, it's really stressful. It's a lot of high pressure situations where you're constantly under the gun to make smart decisions and really perform for your clients. And to be honest, I got really burnt out. I knew I wanted to do something on my own, but I wasn't quite sure what yet. And so I decided to take a year off and travel. And through that year off and traveling, at the time I was renting my condo out. I had bought a condo in Boston at the time and was generating a pretty significant amount of cash flow off that investment. And I kind of just had this aha moment that, if I could scale this and do this on a much, broader scale, I wouldn't have to go back to that corporate 9-to-5 job. And So I had another business partner colleague at the time working at that investment firm, and she owned a triplex, and she was a trader and also really good at negotiation. And so we kind of combined efforts. My husband was a serial entrepreneur, and he started a number of companies, and so he's really great at learning how to build a business and teaching us all that. And so we combined efforts and started Akras Capital several years ago when we got back from our trip.
Nice.
Yeah.
And it's funny how that works out, right? It's like you end up becoming either an accidental landlord. That's how many people started off that way. I mean, that's how I did it. Came up as an accidental landlord, and I realized it's like, hey, wait a second. I was renting out my condo too, and money started flying in. And I'm like, if I can replicate this, if I can do this a bunch more times, that could be a bunch of extra cash flow. And for me, it was more like I was always worried when I was working my corporate gig that I was always living in fear, even working in corporate America, right? And it sounded like in your case, so you were just burnt out. You're just done. You're just done with it.
I was burnt out, but I was also worried because in finance, and like a lot of other different areas, you hit 40, you hit 45, and people start getting laid off. They bring in younger people that they can hire for much cheaper to replace you and do your job. And I was watching all these mentors and people that I had worked with growing up through my career and watching them get laid off at different firms they were at, especially through, 2008 to 10. And they weren't able to find other jobs. That was their whole career spent in this industry. And, the industry had shrunk so much that you had these extremely talented people and they didn't know what to do. And they were, living in these big houses and had gotten their families used to this life. And I was like, I just can't imagine this for myself, like having someone else have so much control over how my life goes. And so that was kind of also the driving force behind starting Akras Capital, is to, take back control of my life.
You know what, Kristina, that's one thing I totally forgot about. I've been doing this for so long now that I totally forgot about that very thing you just mentioned, is that when you do hit that 40, 45 year mark in terms of age, you're now a target. I mean, even at the C level. So I've had C level experience, and you're susceptible to some degree, probably less susceptible, I guess, right? But if you're in middle management and you're in your 40s, I mean, I'm not saying you're going to die, the corporate firing death, so to speak, but you're certainly susceptible to getting fired over some young person, like who may be in their mid 20s with a lot of energy, very, very bright, that can do the same job for a lot less money.
Definitely.
That happens a lot. So, but definitely using real estate as a hedge against such things is definitely a good motivator for anyone listening out there, right? You want to protect yourself and protect your family. Real estate, certainly for me anyway, it's been my lifesaver. It sounds like it was the same thing for you, Kristina. Which is great. So it's great. So maybe take us through what you're doing these days now. So it sounds like you and your team, you started up the company and you've had quite a bit of success with it, right?
Yeah. So we started off, and our original goal, I think like most people, was to buy small. It wasn't single family homes. In our case, we were buying smaller multifamilies. And we just quickly realized that would take a really long time to get to where we wanted to be. And so about 2 years ago, we went to the Best Ever conference and we got introduced to syndication, and we were lucky enough to meet some really great partners at that conference that we've been able to partner with on a couple of much larger deals over the last couple of years. And so now we're actually in the process of selling our smaller multifamily portfolio to be able to trade that up into much bigger assets for our own personal portfolio that we hold. And then also we're looking at larger deals, largely in the Phoenix, Arizona market right now, in order to syndicate and bring to investors.
Excellent. So we wanted to get into more about the management and how you're operating your portfolio, right? So I know that in the green room when we were talking, you and your husband, you guys live in Colorado.
Yeah.
And but it sounds like the majority of your assets are down in Arizona.
So we actually don't have any assets in Arizona right now. That's a new market for us. We have assets right now in Washington State, Florida and Dallas, Texas. And then
Okay.
the way that we kind of operate is we have on the ground partners in those markets that we're constantly in touch with on a daily basis to manage those assets and keep track of them and, make sure we have the right systems in place so that nothing, falls through the cracks.
Excellent, excellent. Well, and that's a big part of it too, right? Is that even for anyone listening out there, if you become someone that could be those boots in the ground, so to speak, and you can prove yourself to be a great operator, that is how you're able to demonstrate to a partner that you are a credible person that can help them out with growing their portfolio too. So, Kristina, what are you doing these days then to help keep an eye on things? Of course, manage the current portfolio with the boots in the ground, and how do you figure out when it's time to scale in those areas?
Yeah. So, I think a good example is our Washington State portfolio. And the reason why we're moving to Arizona and kind of switching it up is over the last 6 months, the regulatory environment in Washington State has changed significantly. And so, my experience is I'm constantly looking at that market, studying the laws, studying what's happening with the regulations. And, it's become extremely prohibitive for landlords to operate in that environment. And, it's even so different from just pre-COVID. And I don't really see it changing. I'm watching what's happening, and I think this trend is here to stay because you have governments that get in this mentality and this mindset, and it becomes really hard for them to then undo what they just did, right? And
Yeah.
I'm referring to limitations on rent growth and evictions and signing leases and we have a really great property manager there in that area, but even their hands are held, right? There's just not a lot that they can do right now. But yet the market is still so hot with so much money and so many investors coming in that we were like, why not take advantage of selling these assets right now? We've been able to force a significant amount of appreciation over the last 2 years and be able to trade up and scale up those assets into a much bigger property. So I think for people kind of thinking about when to scale, when to grow, it's like, have you forced a lot of appreciation and are you able to stack up now? Right? Like, can you take what you have and be able to stack up those assets into something bigger and then do it again and again? And for me, it's like, why sit on all that appreciation if you can just, either refinance, which in this environment has gotten a lot harder, or purchase up and scale up? Why not do that?
Right. Now, just a quick question about market selection.
Yeah.
Arizona is clearly a far better choice than a place like, say, California or Washington State. Are you having a hard time unloading assets in places like Washington?
No, it's been insanely easy.
Really?
Yeah.
Wow.
We had our portfolio under contract in less than 4 days.
That is insane.
Yeah, at over asking price. So,
But it's I wonder why, and it's great that you've been able to do it, but for many big syndicators, even people are starting out too, they generally understand that the challenges of trying to do business in and I don't want to turn to a political discussion, but in those blue states, those blue areas are very, very progressive and make it very difficult for people like us to do business. I have to wonder how they navigate those waters, right? How do they navigate those? But I'm assuming they must have some special leg up on how to manage for that, right?
well, I think that there's just still so much money in the Seattle, San Francisco area. And when you look at those options for investment compared to, other areas in Washington State away from those major metropolitan cities, prices are still significantly cheaper. And it's still a place for people to put their money where they can be relatively close to something. And I think what I've seen is there's still so many people that are scared to kind of buy assets away from where they live or manage things long distance, and they want to be able to be close to things. So I think for those types of investors, it's still, an opportunity and a place to put their cash in markets that are still doing relatively well.
Huh. Oh, well, hats off to them. I won't do it.
Right.
I,
But yeah,
yeah.
I mean, like our focus now is mostly definitely this whole COVID situation has made us much more focused on, being really cognizant of the rights that landlords have in an area where you're investing. And, I just see this trend continuing and seeing it being so much more of an issue going forward. And so you really have to pay attention to the market that you're in.
100%. I mean, that's kind of the reason why places like Texas, for instance,
Mm-hmm.
Florida, they're typically very landlord friendly or somewhat landlord friendly. They don't have to be very landlord friendly, but they're landlord friendly. They're reasonable, and anyone who's listening to this right now is probably an entrepreneur of some kind, probably a real estate entrepreneur, and that's one thing that you have to be able to really navigate is, can you do business there in an environment that where you can still make money and have happy customers? And if it's a very hostile environment for business, you don't want to be there. You don't want to be in an environment like that,
Yeah.
right? So yeah, but I think you're absolutely right. Going into and considering places where we as real estate entrepreneurs can be successful needs to be a part of the strategy. You have to be able to do that. You must. You
Yeah.
must. Yeah. So let's go into some of the processes then. So I know you touched on a little bit of the scaling sort of part of it. What sort of processes are you putting into place? So what sort of things are you tracking on a regular basis to make sure that the property is performing the way it needs to perform, and
Mhm.
making sure that the boots on the ground are still being effective and they have everything they need to be successful?
Yeah, I mean, like most people, we have weekly calls with our property managers to ensure that they're keeping track of everything. On my end, I have, a pretty intense spreadsheet that details out everything from every single unit, what turns we have coming up, when those trends are happening, what the remodel plan is, what the forward looking occupancy trend is, and what our collections and delinquencies are. And just really staying on top of all those numbers and making sure that, it's very easy to like ask the property manager questions on those things, right? Why things are going the way they are and what's happening with leads and how you're able to lease out units. But to like be able to like follow up and have a really great process for tracking their answers and, making sure that none of the questions that you're asking are kind of falling through the cracks. That's kind of where I'm focused and just really being able to manage that process.
Excellent.
Yeah.
Excellent. Yeah, I mean, doing the weekly calls, I mean, we do the same sort of thing. We're measuring KPIs,
Mhm.
everything from what the gross rents should be, what are they at today, how much they collected, occupancy levels, all those different types of things. Are you using technology to help you with that, or just using just like a regular old spreadsheet?
Yeah, they're just spreadsheets that I've built right
Yeah.
now.
Yeah, well, that's all you need, right? It's all you need to really do that. I think as long as you have that touch base and you're able to communicate with the group on a regular basis, you're maintaining that communication, and they know that you care about what's going on there locally. That's
Definitely. And then I think they take a more vested interest in making sure, because they don't want to constantly hear from you,
they don't. It's true.
Oh,
It's like, oh my god, I got to talk to Christina
the more
again.
annoying you are,
I know.
it eventually works out because they're like, okay, we know we have this person that we need to, knows what's going on in their portfolio. So, yeah, it's a little bit funny, but
That is that is funny. Yeah, I try not to be a big pain to
right.
my team,
Very
and
long.
right. We're talking. We do 2 calls a week because we have 2 sets of properties. I mean, it'd be too much to cover all of them on one day.
Yeah.
So we just do it over 2 days, and yeah, it's hearing me complain about operations for 3 hours straight is probably not a good idea for anyone. So,
Um,
although in our case, we actually our occupancy is still up over 95% on our larger assets. So we're doing quite well with that from that perspective, which it's a credit to the team that's actually running it. So that's really good. That's really good from that perspective. So when it comes to the actual scaling, then do you select certain? I know you selected certain markets. Do you continue scaling in a given market? Like how does that part work? Or do you have a limit as to how many units you might do in a certain market or anything like that?
It really depends on our relationship in that market. If it's a market like, for example, Arizona, it's a market that we're entirely focused on right now. And our plan there is to scale as much as possible within that market. But we also have a really fantastic partnership in the Dallas market. And, we're very comfortable with that partnership and that boots on the ground there. And if we were to have a lot more assets in that market, we would be very comfortable scaling as well. So I think it really depends on the asset and the market. I love the Dallas market. I love the Arizona Phoenix market. So I think that's, our main focus for right now. And we don't want to spread ourselves too thin looking, I know groups that are looking at like 10 different markets right now. And the question I have is like, how can you possibly be doing the due diligence you need to, building the team you need to run those assets, and really understanding that market when you're so focused on all of these different markets, right? It's really difficult. So for us, we're very happy staying siloed right now.
Yeah. Well, Kristina, you just touched on something that's absolutely critical. Is that if you're out there listening to this right now and you want to be a boots on the ground type of person, having all that team in place, the construction team, your property management, your inspectors, even your lenders for that matter. Maybe it's a whole set of lenders that some like a group like Kristina can come in, and maybe she has her lenders, but you have better lenders. And I'm sure you wouldn't say, "Oh no, we don't want to use your lenders because of X, Y, Z." I mean, if they can give you good rates, why wouldn't you do it? But part of it is delivering value, number one, and number two is demonstrating competence in that market,
Yeah,
right? That's ultimately what the boots on the ground scenario could be. And it sounds to me like as long as you're able to find a decent person in that market that you can lean on to continue growing and building those relationships with the brokers and all that, then you can continue buying in that area. But I would have to imagine that that's probably the most challenging part, right? Is that in those boots to the ground scenarios, for many of them, they might be part time, or even if they are full time, they're not committed to building those relationships because it's very, very time consuming, right?
definitely. Yeah.
Yeah, yeah. That's the thing. I mean, we've been able to successfully scale and grow our business because, well, I'm only buying in one market, and that's Ohio, and specifically Cleveland at this point. But we built all of our relationships out here. So that's how we've been able to scale and grow our portfolio. And, I would imagine for anyone else listening out there, if you were to do a similar sort of thing, pick a market and become an expert at it, and then partner up with Kristina.
Yeah.
Right. So, well, that's interesting though. So, tell us about some of the assets then. So, what sort of assets are you and your team looking to purchase?
Yeah, so I mean, right now we're looking at solid, probably class B plus assets. I think pre-COVID we were, looking for a pretty heavy value add asset, and we've shifted that mindset a little bit to have something that, is very stabilized and maybe doesn't need like a full crazy gut remodel on everything, but there's just a few things that you can do, whether it's through amenities or slight remodels, to kind of improve the asset and increase rent. I think, on our end, we're super conservative in our underwriting and, pretty much are factoring in zero rent growth for the next, 12 to 18 months. And so you have to be really careful with, we don't know how this whole thing is going to shake out yet, right? Like, we just had unemployment end in July. So far, there is no deal. I mean, there's been, Trump signed the executive order for the additional $400 in unemployment a month. But if you actually dig into the details, it's going to be really difficult on the state level to implement that and for people to actually receive that benefit. So we're just trending into now the first couple of months without that support in the market. And it'll be really interesting to see what happens to delinquencies and occupancy. And, you mentioned in your portfolio 95% occupancy. We've had really great occupancy as well. And I don't think it's been as bad as anyone has thought, but it'll be really, the next couple months will be really telling in terms of what's going to happen. So we'll just have to kind of wait and see there.
Yeah. Yeah. I mean, but you're absolutely right. I mean, right now, yeah, we're doing well, but it's not sustainable. I mean, there's no way you can go on with unemployment numbers. I think, what is it, over 30% still, I think at this point, there's no way to maintain that
No.
and still still have a healthy economy. There's no way. There's just
No.
no way. So yeah, I mean, I think we'll see. I think the next several months, we're probably about 90 or 89 days away from, at this point, from the time of this recording, we're 89 days away from the election. So we'll see what happens post-election.
Yeah.
I think that's what it's going to take. We'll see what happens with that.
Yeah. And in terms of looking at deals in this type of environment, you don't want to be taking on an asset where, it needs such a huge heavy lift and such a huge capital spend that you don't know how that's going to turn out on the backside of things, right? You don't know, what that market is going to look like. And so I think, you really want to focus on neighborhoods, areas that have really diversified employment options for people. You want, we're focused on making sure there's heavy tech employment situation, and making sure that median income is high enough for people might have savings to get by. And so, that's we've kind of shifted from that heavy value add to having a more stabilized, attractive asset.
Yeah. Well, it makes sense though too, right? Because typically those C plus, B minus, B plus, that range of asset typically performs more. The Bs, they perform far better in these economic downturns, right? Because just to your point, the whole workforce housing and the C class, like the middle of the C class asset, they're the ones that take the hit first off. They're the first ones to take the hit whenever there's an economic downturn.
It's not being paid to take on the risk of a C, B minus asset right now. The cap rates and the prices that these assets are still trading at is really not all that much different when you run the risk adjusted return of a more stabilized, better quality asset. So I think right now you're much better off focusing up the capital stack a little bit.
Yeah. Yeah. Now, have you guys considered doing other projects outside of multifamily acquisitions, like triple net or redevelopment or anything else like that?
We're always being shown different opportunities, but I think right now, we don't want to get distracted, and we've been pretty focused on just looking at multifamily.
Yeah. No, I'm always a big believer in just focusing, staying in your lane, and just become an expert at it. Right. That's a big believer in that. So with Arizona being the market you're targeting, typically when you get into a new market, how many assets, or how many units rather, would you buy in a certain area then when you're actually targeting that? So in terms of this BB plus C assets, how many doors are you looking at?
We're focused on at least a minimum of 75 doors.
Okay.
But, and obviously we would like to go much higher, but really 75 is kind of the cutoff, because our goal is to really have on-site management to be able to have the economies of scale from having it really, price-wise doesn't make sense. You're spending a lot of money even on a 50 to 70 unit asset to run it, but you don't get the economies of scale from having an on-site manager and staff at the property. So
That's right. Yeah, and that's the biggest risk, right? Is that from an operational perspective. I often say, if anybody out there is listening, they'll probably hear me. I've heard this. They've heard me say this a million times. It's easier to buy an asset than it is compared to actually operating it for 10 years profitably. That's hard.
No.
That's very, very difficult. Yeah. So excellent. Now, in terms of the number of assets or number of doors you're going to buy. So you might buy like a couple thousand doors in a given market, or really the sky's the limit then, depending on the infrastructure, right? Your operational infrastructure, it sounds like, right?
Yeah. I mean, I think our goal would be to have a few thousand units in the Arizona area.
Yeah. Now, would you worry about having too many doors in a given area, like in terms of maybe cannibalizing existing deals if they're too close, or maybe if there's a local downturn, if there's a problem in that local area, or do you really hedge it against what the different industries that might be in that area?
Yeah, I think as long as your area has enough diversification from an industry standpoint, I would be comfortable having a large number of doors in the same area. I think it all really depends on it's asset by asset, right? So your due diligence of the asset and the location, and there's so many economies of scale that can come from owning a large number of assets in the same area in terms of saving on expenses and costs and managing things more efficiently and having your team really dialed in there. And so I think there's a lot of benefit that can offset, that risk of saying, okay, well, what if something specific happens in that area?
Excellent. Now, for that person listening right now, what is that one piece of bulletproof advice that you would give them if they're on the fence, maybe about starting up in real estate?
Yeah. So when we first got started in real estate, one piece of advice that we got was go as big as you can right away. And, we kind of took that advice and we're like, well, we really want to learn the ropes first and start small and then grow. But it is so true. It is just as easy, or I would say just as hard to manage a 100-unit asset as it is almost a 4-unit. There's a lot of work that goes into both. And it's really, while it's a lot of work for the 100-unit, it's really not that much more work than a 4-unit. So go as big as you can, and you are going to learn along the way. So I think, everyone makes mistakes. Don't be scared of making mistakes. The most important part is just to get started.
That's right. And it's funny. I say the same thing. I tell we do consulting, and we also do training, like one-on-one training. I tell my students, try to find the biggest deal you could possibly handle, and go from there. Because it's if you do make a mistake, chances are you can recover it far easier on a larger deal than you could on a small one.
Absolutely.
Yeah. Excellent. All right, guys. Well, if you want to reach out to Kristina, you can reach her through her website at akrascapital.com. I hope you got a lot of really good insight on how to generate that passive income and live the life of your dreams, ultimately, is what it is. And that's why we do this business. That's why we focus on real estate, and we've actually been able to really live the life that we want to live. And I hope you guys can do the same sort of thing. So take care, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.